On today's public keys from the New York Stock Exchange, Bitcoin ETF saw nearly $1.8 billion in outflows last week. Is the Ethereum Foundation headed for a funding crunch? And if so, who steps in? We break down a short against MicroStrategy that's already up more than 40%. Plus, Moody's is embedding credit ratings into tokenized assets, a major step for institutional crypto. All that ahead. I'm Jen Sanasie here with Dave Lavelle. Let's get into it. Happy Monday, everyone. Today's episode is brought to you by Kraken Pro, regulated spot margin trading. It's finally available to U.S. traders. Size your trades to match your conviction. Trade margin on Kraken Pro. Dave, you are co-hosting with me. It is my favorite show every time you are here.
So it's great to be here. Happy Monday. Let's do it.
Let's do it. Okay, let's start with that $1.8 billion I mentioned off the top.
Mass panic, right?
Mass panic. Last time we had a number that was over $1 billion, you said we shouldn't actually be panicking. We should be looking at things holistically. Is that still where you sit today?
Here's the deal. We always think about ETFs as these buy and hold vehicles, but they truly are institutional capital markets vehicles that allow for high quality getting in and getting out for very fast movement of getting access to any asset class that an ETF has exposure to. So S&P 500, gold, other commodities, currencies, other broad baskets, obviously the industry sector weights. And Bitcoin is the same. Bitcoin has eclipsed 100 billion in AUM in the total complex. So seeing a billion or two come in and out of the complex is really not that big of a deal. But if you actually take a step back and kind of try and parse apart institutional use of Bitcoin ETFs and retail use of ETFs, what we've seen is that those kind of lower fee profile products, so maybe Morgan Stanley's product or Grayscale's low fee products, both on the Bitcoin side, BTC, and the Ethereum side, ETH, have seen net inflows for this year. What does that tell you? It means that the ETFs are really high quality capital markets tools to kind of get in and out of the exposure while the buy and hold investor are still allocating. And I'll remind the viewers and you that these buy and hold allocation products haven't really been totally added to the advisor platforms yet.
Yeah.
And so, I think there's a lot more to come and we're still in the early phases of it. So no panic, everybody, everything's fine.
So the headlines that probably have a little bit of a sensational headline on this video. The headlines that ETFs are bleeding are just that sensational, and we got to look at the full picture to see that when it comes to crypto ETFs, it's still a positive story.
Yeah, when you have 80, 90, 100 billion in an asset class and you have $1 billion coming in or $1 billion going out, it's really just kind of the ebbs and flows of what we're seeing on the institutional side of things.
The price of Bitcoin this morning, last time I checked, was just under $60,000. Right. We also had some news come out from MicroStrategy, a new capital plan. Curious how you're looking at Bitcoin as we head into the week, and what was your reaction to that MicroStrategy news?
The MicroStrategy news for me was actually somewhat of a clarifying point because I know there was kind of an overreaction, a little bit of panic. I think it was a couple of weeks ago when MicroStrategy sold, I think, 32 Bitcoin or something like that. Nobody really paid attention to them buying 1,500 Bitcoin the next week. So I think hopefully this is a little bit of clarification to the marketplace that if in fact Strategy sells some Bitcoin in the future, that's actually part of their plan and won't shock the market as much as, I think the marketplace thought it did a couple of weeks ago.
That was a complete overreaction. I mean, 32 Bitcoin compared to how much Bitcoin MicroStrategy is holding on its balance sheet. I was kind of shocked that people were panicking the way they were.
I think people were trying to look for a story, and part of, my thinking was there was a lot going on at that point in time in market. Obviously, SpaceX was pricing, and I think there was kind of taking a little bit of taking a little bit of air out of the balloon and maybe a reallocation or a redistribution of individuals' capital to maybe, go into SpaceX or other kind of AI-related strategies too.
This show is all about crypto, crypto converging with TradFi, crypto converging with institutions. And one of the big narratives that we saw last year was digital asset treasuries.
I know.
I'm reminded of that every time we talk about strategy. Everyone was saying this is going to be the year of the digital asset treasury. It's really going to change how institutions look at crypto, and then that kind of fell flat. Do you think the digital asset treasury narrative is going to pick up again, or is it going to look different?
Well, I think if we went a year ago, it was really a story of, well, we have some uncertainty in the regulatory framework or the legislative framework, and so therefore digital asset treasury companies are going to offer the opportunity to kind of have, a really definitive access point for, different strategies, different protocols. I mean, fast forward to like now, you still have a little bit of uncertainty on the regulatory and legislative side, but in a little bit of a different way. So I think some of the strategies that we're seeing coming out of the digital asset treasury companies are shifting a little bit, and I think we have to understand it better. So I'm excited to talk to Joseph today. I mean, he's really been at the forefront of this, and that's exciting for the Ethereum Foundation, obviously. His digital asset treasury company as well.
Yeah, we are going to talk to SharpLink CEO Joseph Chalom right after the break we're going to take. I'm excited to see how he's thinking about the future of digital asset treasuries and how he's going to offer investors more than just holding ETH on the balance sheet. All right, we are going to take a quick break. When we come back, Joseph Chalom joins us. Ever had a trade you called right but size too small? It happens all the time, and it can change today. Regulated spot margin is finally available to U.S. traders on Kraken Pro, up to 10x, the size your conviction deserves. Head to pro.kraken.com and start trading today. Get the breaking news that moves markets right to your phone, track your favorite token instantly, and dive deep into the latest data. Download the CoinDesk app today. The Ethereum Foundation has seen a wave of recent departures, raising questions about who will steward the network going forward. Now, a group of former Foundation researchers has launched a nonprofit R&D lab, ETHlabs, backed by SharpLink Gaming, BitMine, and Joseph Lubin. Meanwhile, SharpLink just priced a $75 million raise last week. Joining us now to break down what this all means for Ethereum's future is SharpLink CEO Joseph Chalom. Hello.
Great to see you both.
Great to have you here.
Great to have you here.
Can I start?
Yeah, go for it.
Okay, I'm super excited to ask you just where are digital asset treasury companies today versus where they were, let's say, a year ago? I think I was just mentioning that we have traded regulatory and legislative uncertainty, and we're kind of seeing a little bit of a resurgence in my mind of attention being paid to digital asset treasury companies. You're obviously leading one of the largest, so give us your feedback.
I think just for your viewers, it's really important for them to understand that a digital asset treasury company, in our case, SharpLink focused on Ethereum, is there to give investors, through a public equity, directional access to the underlying token, in our case, Ether. You saw a large launch last summer of Bitcoin, ETH, and Solana treasuries. I think what we're seeing right now are those who are managed responsibly, who are able to raise substantial capital, are going to be survivors of what feels like a really deep consolidation in crypto. So I think we're positioned well. We raised additional capital last week in order to both buy ETH, be prepared potentially for share buybacks, as well as to fund operations during this down period.
I want to talk about how you're speaking to investors about ETH. I just talked about the Ethereum Foundation. Some former employees are saying there's a 6 to 9 month funding crisis. We have executives leaving the Ethereum Foundation. We have Ethereum on this progressive decentralization journey. How do you talk to investors about what's going on there and make them feel good about their investment?
Sure. I think there's a divergence happening right now, which is short-term price consolidation. I think poor messaging that's come out in the Ethereum ecosystem. At the same time, there are two things to be massively bullish on. First of all, crypto adoption by the largest institutions in the world has never been stronger, including by your parent company Bullish making a bet on tokenization. You see likes of BlackRock now participating in DeFi. Tokenization is going really, really strongly. I think the short-term challenge has been a sentiment issue. So first of all, you have seen a lot of levers from the Ethereum Foundation. We're really pleased to announce that along with Joe Lubin and Tom Lee, we're funding some of these spinoffs, and they have some of the densest capital and talent. So when you talk about what's happening, you're going to see ETHlabs launch, which we announced last week. You're going to see go-to-market activities be supported, and you're going to see privacy activities, like 3 of the most important foundations of ETH. And it's not all going to happen in the Ethereum Foundation anymore. We're going to move to a multi-node set of groups who are funded by the largest stakeholders while still being independent. That said, I think we need to get past this period of geopolitical lack of liquidity, geopolitical events that are holding down, and then the largest treasury in the world from a crypto perspective is Michael Saylor. Now we have daily announcements that I think are unsettling the market. You take a step back, the long-term view is really, really bullish. We're just in a short-term consolidation period based on those three factors I just mentioned.
Yeah, we've seen these kind of winters come through, and this is my second real winter, although I've been paying attention to the space for longer. But talk about that investment, $75 million at a premium to the current stock price. I believe at a premium, if I read correctly, to the net asset value of the Treasury company as well.
Yep.
Talk a little bit about that. Is that your target strategy to start bringing in kind of institutional capital that you feel like is going to be longer term? Like what's behind that?
So our North Star is not to accumulate as much ETH at any price, because you can actually dilute investors. Our North Star is to increase the ETH concentration per share. And for that reason, when our multiple to NAV was below 1 for most of last year, we raised billions of dollars of capital. When it's dropped, like most other digital asset treasuries, below 1, we won't raise equity capital and dilute our investors. What we ended up doing is issuing new shares at a premium to the current stock price and providing warrants to that investor. And the reason that's really important is, as I mentioned earlier, it allows us to start buying ETH again, which we did last week. It allows you to have runway just in case the price of ETH is low for a longer period. And importantly, we announced last summer a $1.5 billion share buyback authorization, and it puts us in a position that we can use these dollars wherever it's most accretive for investors. And we're going to do it deliberately. And to your point about institutions, we're the most institutionally held DAT other than strategy at about 48% at the last measure, with Fidelity as our largest shareholder. So we've been trying to be actually quite conservative. We haven't taken out debt. We haven't issued prefs, because you need to be able to season and mature for investors and survive a downturn, which we have.
Yeah. So if I'm an institutional investor in quick math, and I'm not as eloquent on this, but if I want to put $75 million into SharpLink, can't I just go into the secondary market and buy it? Now, I'm not going to get the warrants, but it seems to me, I think if I did my math correctly, it's 10 million of trading volume a day at least, and I can kind of, why wouldn't I have just bought it in the secondary market? And why wouldn't you have wanted that to maybe have a nice little support level for the price?
So
what am I missing?
We can't control who buys or sells in the secondary market, but there are investors who love the volatility of ETH and SharpLink as a stock, and opportunistically, they're willing to pay a premium today in a private transaction to buy common stock. They bought our stock at a 40% premium in order to be able to buy the upside over a multi-year period, because they're essentially buying and selling and arbitraging the volatility of an asset.
All right.
So it actually is really, really good for shareholders and allows us to raise capital in a manner that's accretive. We haven't raised capital that will dilute investors like many other DATs have done. Because our North Star is ETH concentration, not accumulation at all costs.
So my guess is if you're willing to put 75, bucks in at a premium, then you're probably participating in the secondary market as well, as my guess. I have no idea, but I'm just,
I think these people are very interested in having that upside convexity, and they like the volatility of this trade.
Cool.
Yeah.
You talk about it being an ETH supercycle. When do you anticipate price to catch up with this institutional supercycle?
I think there's three things we need to get through in the short term. We need some more clarity around interest rates. We started the year thinking we'd have a 75 basis point series of cuts. Instead, the markets are pricing in a 25 basis point raise in September.
It's incredible.
It's incredible. It's largely because of a temporary inflation surge from oil prices. So I think you need the Iran conflict to be cleared out. You need interest rate stability so people understand we might get one raise, but not two or three. And then finally, you can't overstate the Michael Saylor overhang on the price of Bitcoin. And when the price of Bitcoin is uncertain, the price of almost all other cryptocurrencies are uncertain. But to your point, the crypto cycle is here. Stablecoins are getting adopted globally. We've seen Japan, Singapore, Hong Kong, soon to be Korea. And now we're starting to see significant tokenization of assets. I mentioned your parent company, Bullish, buying Liquidity. They've spent $4 billion plus because they want access to almost 3,000 public companies that they can tokenize and then trade on exchange. Like, this is a long-term bet, and I'm bullish on the long term. I don't make price predictions, but I'll tell you what I said to you when I saw you last in Miami at Consensus. I think the entry point right now from a risk-reward perspective is as good as I've seen, not necessarily for a daily trader, but for a longer-term investor.
Dave and I were just talking about regulatory uncertainty at Consensus.
Yep.
Patrick Witt told us that Clarity would be passed and signed by July 4th. That date is creeping up on us. I don't think that's going to happen. If that doesn't happen, what's your outlook? Does it change?
I think my outlook is, I think the likelihood of that happening is now sub 50%. I'm still optimistic that if it doesn't happen by the August recess, it'll happen this year. I do think the regulators now, with the CFTC and the SEC, can probably rule write most of what we need. The problem with rule writing is it's much more reversible than what you see when it joins statute. I've been spending a lot of time in Asia. I've been in Korea and Hong Kong 4 times in the last 9 months. They've, on the one hand, been waiting for the Clarity Act. I actually think if it's not passed, you're going to see Asian local governments pass equivalents to try to catch up and even get ahead of the US. So I'm long-term very optimistic. I just think we need, no pun intended, a lot more clarity, not just about US regulation, about global rates, and about the geopolitics. And let's not underestimate, you go to South Korea and all you hear about is Samsung and Hynix. We need this AI supercycle to run its course. But in the short term, there's a lot of competition for that liquidity that historically went to crypto as a risk-on asset.
All right,
Yeah.
we got to leave it there. You want to take the last word?
No, I was just going to say that I think you're absolutely right that when you talk to, or you hear Chair Seelig, or you hear, Chair Atkins talk, they want to future-proof things, and so they're not going to get in the way of the Clarity Act. But if there's going to be some uncertainty there, they're certainly going to go forward and make some rules that'll give us the rules of the road that we can charge forward with. But
I'm an optimist. I don't look at daily price, even weekly price. Now is a great entry point into high-quality projects. I think into Bitcoin, ETH, and those who are going to benefit from this institutional supercycle. It might be painful in the short term, but long-term investors actually make more money investing against cycle, and we're clearly at the lowest point of the greed and fear index. It's 12 today.
Yeah.
12
It was
means
8 a couple of weeks ago.
12 is
so we climbed a
extreme
little
fear.
bit.
12 is extreme
50% retrenchment.
which is where smart money often makes long-term returns.
Great.
Joseph, thanks so much for joining us.
Great having you here.
Great to see you both this
Yeah.
morning.
Be well.
That was SharpLink CEO Joseph Chalom. All right, let's now turn to 10x, brought to you by Kraken Pro. Now with up to 10x regulated spot margin in the U.S. Make the right read at the right size with margin on Kraken Pro. Each week, we feature the highest conviction trades from some of the most recognizable traders. This week, we're joined by Kaizen founder Brian Jung.
My high conviction trade right now is actually on a MicroStrategy short. So there's a lot of FUD happening right now on the timeline, and this is concerning with Michael Saylor and him unwinding right now, diluting his shares with MicroStrategy. So I actually found a different expression on that play. Instead of having a full short, I found a 2x inverse short ETF. It's actually called ticker MSTZ. So anytime MicroStrategy goes down, this actually goes up quite a bit. So in the last 7 days, they're actually up over 70%. I'm currently up over 40% on it. So I enter this trade at about $12. I plan to exit this at $20, and the leverage I used was 2x. The biggest risk here is if we do see some sort of bounce with Bitcoin and MicroStrategy actually goes up, this short is going to reverse on me. I'm gonna probably start losing some of the gains I have, but I'm well in the money at the moment, so I'm not too concerned.
Thanks, Brian. That was Kaizen founder Brian Jung. That segment was actually recorded last week. Today, strategies up about 5%, and MSTZ losing some gains, up around 40% in the last 5 days. All right, let's get to the next one. Moody's Ratings is now embedding its credit scores directly into tokenized securities on Solana, bringing independent credit analysis on chain. The ratings giant partnered with tokenization specialist Alpha Ledger for the expansion. Here with more is Managing Director and Global Head of Digital Economy at Moody's Ratings, Fabian Astic. Hey, Fabian.
Hi,
Thanks for having me.
It's great
Good
to
to
have
see you both.
here. So
Yeah.
we come on and we talk about the institutionalization of crypto and the convergence of TradFi with crypto. I mean, could there be a better example of this than Moody's getting involved in credit ratings for the underlying assets and stablecoins. Tell us about your stablecoin product very briefly, and I've got some follow-up questions as well.
Yeah, absolutely. I mean, the market is going to be tokenized. There's a number of benefits that come with tokenization, and we've been talking to the market for a while now, and they see it, but a few ingredients are missing, and one of them was digital cash. Turns out that there's a number of candidates out there, including stablecoins, and they're becoming reality. More than $300 billion of market cap at the end of last year, still growing, a bunch of new stablecoins since January 1st of this year. And the natural question from the market was, all right, so now that there's digital cash available for all those tokens out there, so that we don't have to settle off-chain when we do everything on-chain,
Right.
Is there credit risk coming with the stablecoin that we will be settling with?
Right.
If you settle with central bank money, there's no credit risk. If you settle with a stablecoin, there is credit risk. And that's what we wanted to address. It was a question from the market. And we developed a credit rating methodology to assign actual credit ratings. First time it's done. And we have a bottom-up approach where we look at the reserve assets.
Right.
We look at the market value risk, credit risk, liquidity risk of the assets, under pressure and stress conditions in particular. And then we go all the way up, operational risk, legal structure, regulatory environment, and we assign credit ratings.
So my question is, if we're taking a look at and you and I have talked about this, you take a look at the credit rating of the underlying assets. You have the Genius Act that has really kind of given a thumbs up or a thumbs down to whatever's going to be kind of acceptable as collateral for a stablecoin that's going to be Genius Act compliant. Mm-hmm. What added value are we actually getting from that credit rating when you say, we've already kind of given a thumbs up from the, kind of legislative perspective. So what's the value there? And why can't I get a credit rating on the actual parent to kind of understand the quality of kind of how the stablecoin, apparatus in its entirety is being run?
All right, so there are a couple of questions in your question here. First, the regulatory requirements out there, whether it's Genius here in the US or other frameworks in other countries, they are minimum requirements so that you don't break the system from the inside when you issue a stablecoin. But it's very point in time. In fact, most of them tell you $1 assets for $1 of stablecoins, which is great today. But if you're trying to look through the cycle to see whether your stablecoin could get weaker over time, which is important if it sits on the payment leg of a transaction, for instance.
Right.
It's not just today. It's like if the transaction lasts 5 years, you want that cash to be available for 5 years.
Sure.
So at that point, you need extra analysis that goes beyond what the regulatory requirements say.
So not just a snapshot every quarter.
Not just a snapshot. That's also the behavior under stress conditions that matter. And a number of other aspects like governance and all of that that might be in some of the regulatory requirements globally, but we just zoom in a lot more, and the picture is through the cycle.
Got it. That's helpful.
Yeah. In my introduction, I mentioned the token integration engine launching on Solana. I know you launched on Canton a few months ago. I think we spoke back in May with Moody's about token integration engine on Canton. Why these two chains first, and why not Ethereum? We were just talking about Ethereum with our last guest. If we're talking about tokenized assets, I would think you would look there first.
So we are completely agnostic to the blockchain platform that's used for that activity. We will meet the stakeholders of Moody's wherever they are, and it can be on blockchain platforms. It will be on other types of digital platforms as well at some point. We just want to be ready to meet customers, stakeholders, issuers, investors, partners, regulators, wherever they want us to be. Turns out that we had partnerships with Canton and Alpha Ledger. There's a lot of tokenization activity happening on those chains, but we'll continue to expand to many more chains going forward without naming any chain in particular today, but we'll be able to speak in near future about further expansions.
He's just inviting himself back.
I know. I kind of like it. I kind of like it. That was suave.
Well, anyway, we're thrilled to have you here and always giving an update on, real world examples of where we're having a convergence of TradFi, having Moody's, bringing governance, bringing independence, bringing institutional grade quality is something that is really akin to what we're doing at CoinDesk. because we want to make sure that we're kind of approaching the institutional investor and the institutional market in a way that we're going to have credibility in crypto. So it's always great to have you here.
The market is increasingly digital. There's no doubt about it. We are telling market participants what the risks and opportunities are in that space. As you see more and more of those assets, investors were telling us there's a lot of buzzwords coming from the technology space, but what's in it from an economic and financial perspective for us? And that's really what we're doing here. We're just trying to go back to the fundamentals and tell people what that new environment is about, and it's really about finance and economics.
What are you hearing in these conversations? What are market participants most worried about?
I would say there was a lot of confusion for a few years. In fact, there's been a gap, still exists, between supply and demand. On the supply side, a lot of companies have been ready to issue digital assets, and regulators have been getting ready, and lawyers and structures and quants ready for the modeling of all that stuff. On the investment side, on the demand side, people were reluctant to get in because of the confusion, because of the noise, some bad events happening in the crypto space per se, not necessarily seeing that there was another part of digital finance that's going to grow a lot faster in the coming years, that tokenization part of digital finance. And so I think there was that need for education that was important and that we've played a role in. People are getting more comfortable, but what we're hearing is, tell us about things that can only happen in a digital finance ecosystem and that otherwise would not be available off-chain, essentially. So the more examples you see like this of things that could not be done otherwise, I'm thinking about collateral mobility, for instance, which is a key topic, $255 trillion of eligible liquidity that's trapped in the system, in legacy systems. And with blockchain platforms, essentially, you can free that up and you can move your collateral around when you need it to be moved around. That is a key example of things that the market is now recognizing and that investors are getting more comfortable with because, again, they're seeing the economic utility of it as opposed to just hearing about technical aspects of blockchain and governance and cyber risk. So it goes way beyond that.
It's not a story of frog coins and pictures of apes. This is a story of real-world examples of real-world benefit to very large-scale institutions, and collateral treatment is a perfect example.
A more mature story. Fabian, thank you so much for joining us.
Great
it was a
having you.
pleasure.
Thanks for having me. See you soon.
See you
Thank
soon.
you.
That was Moody's Ratings Managing Director and Global Head of Digital Economy, Fabian Astic. We're going to take a quick break. When we come back, is privacy the missing piece when it comes to the institutional adoption of crypto? Stick around. Ever had a trade you called right but size too small? It happens all the time, and it can change today. Regulated spot margin is finally available to U.S. traders on Kraken Pro, up to 10x, the size your conviction deserves. Head to pro.kraken.com and start trading today. Get the breaking news that moves markets right to your phone, track your favorite token instantly, and dive deep into the latest data. Download the CoinDesk app today. As tokenization and stablecoins move deeper into institutional finance, privacy is becoming a critical piece of the puzzle. Midnight Foundation is building the infrastructure to meet that demand and recently partnered with Monument Bank to explore how privacy-enhancing blockchain technology can support regulated financial institutions. Joining us now with more is Midnight Foundation President Fahmi Syed. Hey, Fahmi.
Hi, Jen. How are you?
I'm doing well, thanks. How are you doing?
I'm very well, thank you.
Great to have you here, Fahmi. Okay, can we start?
Let's just jump right into it.
Monument Bank.
Yes.
I saw some number like $7 billion in reserves. Who are the clients?
Yes.
Tell me about that makeup. How are you plugging in there? Why did you choose them? I'm like so curious because I read what I could read, but I had some unsettled and unanswered questions.
Yeah. Well, Monument Bank are a UK-regulated neobank. They have $10 billion of
10 billion.
assets. So 7 billion sterling translates to $10 billion.
I gotcha.
And they service mass affluent. So the people who have too much assets for retail, high street retail banks, but not enough for the very large private wealth banks. and they are looking to service those individuals, those professionals with liquid assets. And they approached us. I was on a panel talking about why privacy matters. They had been in search for a partner in this blockchain space. And the plan with them is to take their cash deposits and initially tokenize up to $300 million worth of those assets on Midnight. Midnight is a permissionless network which allows private solutions. So they're going to create a private domain for their clients to tokenize those assets, phase one.
That makes great sense. So I think for the US viewers, one of the things that is very curious to me when you start to look at the European landscape is this concept of like advised wealth or having an advisor for somebody who has a bit of money.
Yes.
Exists in the US, but it doesn't really exist in the European market, largely because the state-sponsored pensions are going to take care of most of that obligation.
That's right.
But then you have this unique spot where you don't have the massive private wealth manager as you had described. And so this is really servicing that kind of in-between, which makes a ton of sense. And privacy is going to be a matter of concern for these individuals.
Yeah, absolutely. So Monument have done a great job. As I say, they're one of the fastest growing banks in the UK, regulated by the Bank of England. They've done a great job on traditional rails. But what they recognize is these mass affluents want to go and invest in hedge funds, in private equity firms. And maybe they don't have the minimum ticket size of $500,000, $1 million.
Right.
So what we can do as part of phase two is once they tokenize their cash deposits, is then enable them to switch those into tokenized assets. So money market funds are interesting, but they can be accessed through traditional routes.
Sure.
So it's access to these funds that are typically outside their reach. So fractionalized access to private equity funds, hedge funds, and others beyond. So to the Monument Bank client, they go into the banking app, they select what investments they're eligible to go and invest in. They don't even know Midnight or blockchain, it sits in the background. And that's the beauty of good technology, it becomes invisible. And that is part of phase two of that project.
Right. So a couple of times we've mentioned on the show today about how our parent company has made a massive bet on tokenization in the acquisition of Liquidity.
Yes.
One of the largest transfer agents in the world. But what I'm hearing from you is your play on tokenization is really kind of in the private markets or the alts market, whereas I think Bullish is kind of primarily focused on kind of accessing the, somewhat a $300 trillion kind of equities market. So talk about how you see tokenization kind of starting to accelerate and where you think it's going to happen first.
Yeah, so for us, we think tokenization as well as stablecoins are where the blockchain industry is moving towards. It's maturation of the technology aligning with institutional demand. But even in the equity space, our large brokerage firms are going to enable their clients to hold these assets on a public blockchain.
Right.
Because we know with the advent of AI, we're seeing more and more hacks coming to blockchain, more and more smart contracts. We've seen the issues around the access, the hack around the Aave sort of protocol on the bridge. So what you need is protection around that. And the protection comes through being able to shield your assets, being able to shield your address, protecting your metadata, the who you are, the what you are, but also what you hold. And through Midnight, we can do that, but then also build smart compliance through smart technology, smart contracts, make selective disclosures. So hold it privately, but disclose to your custodian, to your regulator, to your bank, what you're doing. So everything becomes compliant.
Right.
The Monument partnership launched a few months back. We spoke when that launched. You have this 3-phase rollout. Where are you? And are we going to see more partnerships like this in the future?
Yes, so we have other conversations happening with large, both European investment banks, US investment banks. Many have gone down the route of building private chains, but those private chains become siloed. And even when they go and do a transaction or test transaction on a public chain, they then expose a little bit of metadata. So for us, we're having those conversations about how we protect that metadata as well as transaction levels. And beyond that, we've got this new concept of a collateral warehouse coming to Midnight. The ability to have multi-chain signatures where one wallet, one vault on Midnight can control all your blockchain assets privately, securely, so that you can then represent that as proof of collateral for better access to borrow, lending, to trading, margin accounts, things of that nature. So we're excited by that. That should come somewhere in Q3, hopefully ahead of token, and we can represent it then.
It's interesting. Oh, go ahead.
Go ahead. I'm sorry.
I was just going to say, it's interesting that you're seeing folks experiment on private chains and then go to public chains. Do you see a future where private chains exist for certain use cases and other things are happening on public chains? Like, what? That's an interesting. That was interesting for me to hear from an institutional perspective.
Yeah, so I think there will always be private chains. Today, institutions are comfortable having private databases. Mm-hmm. That's where they keep their client information, their own personal information, their corporate information. But they have to go and send a message, whether it's SWIFT or FedWires, they're sending a transaction. across a public, maybe permission network. So what we see is a future where you have Web3 merging with Web 2. We call it Web 2.5. That intersection of private permission, corporate access, maybe using permissionless rails, but permission rails that give you protection around with privacy-enabled solutions.
So if I could have one more question. If you were to prioritize where Midnight is going to be spending resources, both time and money, to expand its business,
Yes.
regionally around the globe, how would you prioritize it? Where is the U.S. vis-a-vis where you are with some of what is happening in the UK or in Europe as well?
Yeah, so what we've done with Monument Bank in the UK is a precedent to what's coming with the Clarity Act. The Clarity Act is asking for exactly this. More and more banks will want to tokenize assets on chain rather than use stablecoins and then convert those tokenized cash deposits into other transactions, other assets. So we see transactional progress here in the US. We're seeing progress in Japan with some counterparties we're speaking to there. We think the Collateral Warehouse will unlock a lot of value for institutions, but also at the same time, we have this concept of night mode within Midnight. How do you take assets, or how do you introduce privacy into other networks, into other solutions? So how do you create a private version of these lending borrowing protocols that we see on other chains and extend Midnight's solutions into those?
So is expansion in the US market predicated on Clarity Act getting through?
Not necessarily. Okay. I think there are conversations that are happening with very large banks who, whether that tokenization route happens or doesn't, are still interested in how they take their private siloed information or assets and exchange that with another counterpart.
Makes sense.
Fahmi, it's always a pleasure having you on. It's great to see you.
Thank you. Pleasure
Great to see you.
That was Midnight Foundation President Fahmi Syed. All right, that's it for CoinDesk's Public Keys at the New York Stock Exchange. Dave, always a pleasure having you as a co-host.
Fantastic being here. Until next time.
Until next time, for Dave Lavelle, I'm Jen Sanasie. We'll see you next week.